Welcome everyone to the 2025 tax planning webinar. I've been looking forward to this one, and especially this time of year. But before we get stuck into the juicy bits of today's webinar, just do a quick reminder or a quick bit of housekeeping is if we could pop cameras on. Thanks, John, for leading the charge there. It just makes it feel a little bit more like a workshop versus a webinar or me just talking to a screen. And we can keep it super interactive too. So the third point there says have the chat box handy, but one level up from that is actually if you've got a question, very, very welcome to take yourself off mute and pop the question to me verbally. And then the other thing is you might notice that Zoom's a little bit different. I'm not sharing my screen. My camera is doing the sharing for me. Whoa, there we go. So you'll see, wrong button there, that my slides are actually on the right side of me there. All right, so the best result will be to change the Zoom screen to full screen if you haven't already. That way you can see the text on the slides. Alrighty, I'm seeing a few familiar faces here, but just if you don't know who we are, I run an accounting firm called Inspire. We work with small businesses all around Australia, and our base is in the Fortitude Valley in Brisbane. We've saved our clients over $37 million in tax and accounting, and this part of the year is when we usually see the tally there rocket up a few $1 million every single financial year around this tax planning time, which is all about the topic of today's webinar. So yeah, we'll give you some insight into how we do that. In terms of an intro to me personally, so I started Inspire when I was 23 years old. I'm an award-winning chartered accountant with over 18 years accounting experience now, and the author of 2 books, Wealth for Life and It's All Sorted. And the book, It's All Sorted, actually talks to the topic we're diving deep into today, which is a whole heap of focus on our ability to save tax. And if you do want a copy of that, then there is a QR code on the screen, or Tay from our team has just posted the link in the chat box. If you are a client of Inspire, because I see a few clients here, don't buy the book straight off the website. We do have a discount code for clients if that is something that you want to get your hands on. Alrighty. So what are we going to cover today? There's sort of 3 main topics. We're going to cover through the importance of tax planning and actually what's the process of it and how it benefits your business. Next thing is how to legally minimize your tax savings before the financial year ends. And that's one of the keys here is we need to take action before 30 June or well before 30 June. We're starting to roll out tax planning meetings. Even now, I was actually surprised we're already doing meetings. I heard the team have 1 or 2 this week in mid-March. It's pretty crazy. So yeah, the idea is to take action well before 30 June. And then the last one there is an opportunity to do live Q&A with me to see if there's any of the questions we can get answered for you today. Alrighty, well, what is tax planning? It's a process that we do as accountants between March and June of every single financial year. And pardon me, let me stop those sounds. No. Am I still spotlighted, Rose? Yes, cool. All right. Between March and June of every single financial year. And the process is because we've got an idea, and we're talking in March right now. So the March quarter hasn't finished yet. But if we're doing this process in April, May, June, we've got 3 quarters of the year that have finished and we've got 1 remaining quarter of June. So we actually estimate what the profit position is going to look like for the full financial year because we already know 3 out of the 4 quarters. The next point is to advise and decide on the strategies that we're actually going to implement for tax planning. And that usually involves a meeting with the client. We do some pre-prepared work in terms of working out what the client might be eligible for in doing there. And then we meet and discuss. Now, some of those strategies actually require cash to move around. And so sometimes the client is up for that. Sometimes, sometimes the answer is no. And we'll go through some examples today where you do need cash to move around, and some clients opt in, but some don't. And then the last step there is to implement anything that we need to do. And again, in most cases, the idea is we need to get these things implemented before 30 June. So again, we've got a 3.5 month runway to that date, but we're talking about the 2025 financial year. We need to get these things sorted before 30 June 2025. Now, what does it look like? We've got a massive, gigantic Excel. If we've got clients on today, you might have seen our group tax summary. That's what we use as a basis to run our tax planning scenarios. But to give you an example, let's say a client starts with a taxable profit of $300,000, and their average tax rate, based on how it's spread throughout the family group, is 25%. Therefore, the tax is 75 grand. Now, through the process of tax planning, the taxable profit might drop 50 grand down to 250K. And the average rate of tax, because maybe we've spread stuff across the family group into different entities or people, we're looking at an average tax rate of 22.4% instead of 25. And therefore, the tax payable after the tax planning is 56 grand. And the difference between those two scenarios is the 19 grand. Now, that is the value of tax planning to the client, but also the tax savings that we include in our $37 million tally and counting. So that's a ballpark or high level view. And I'm pretty sure the next step is to talk about some of the strategies that we might implement. Again, keep in mind that 30 June is the key date here. I've said it 2 or 3 times already. I'll probably say it 2 or 3 more times because it is very important. And again, what tax planning isn't is a phone call to the accountant on the 29th or the 30th of June. That will not get the best outcome for a tax planning perspective, because often that is sometimes too late, especially for things like superannuation and bits and pieces like that. All right. So again, let's run through some tax savings strategies. Now, the first one we'll talk to is writing off bad debts. Now, I'll talk to the technicality of how these rules are written first, and then we'll come back to practically how it applies. But to claim a bad debt in your business as a tax deduction, you need to actually write that off, and you can only claim the bad debt at the time it's written off. So if you write off bad debts in July, that you could have written off in June, they push forward another financial year to when you're able to claim them. So what I would recommend in terms of writing off bad debts is set a date in the calendar for mid to late June to review your accounts receivable. You can pop a date in your calendar right now if you'd like to review that. And the whole idea is that you review your list of people who owe you money. Now, most accounting programs, you can run what's called an aged receivables report that show debts based on, either 7 days, 14 days overdue, 21 days, or some of them are 30, 60, 90 or 90 plus. And what I would do is obviously start with the older ones first, because if they're way past your terms, then and they haven't paid and you've made attempts to collect them, then it is likely that they will be uncollectible. Now, the idea is that in your accounting system, you write them off as bad debts through your accounting system. And again, do that before 30 June to claim them in this financial year. Now, I'm not suggesting this to be silly about it, but let's say you did that, you wrote off debts, you thought something was uncollectible, and then all of a sudden someone appears out of nowhere and pays you the invoice that's due in August. Then all we do is go and re-raise that invoice and receive it as income in that year. So yeah, again, that is the process to sort that one out with bad debts. Next one here is gift cards under $300. So this is an example of a strategy where I would only recommend this strategy if you're going to do it anyway. Now, the whole idea here is with non-entertainment gifts, such as gift cards, you can actually give a gift to your employees. And if it's under $300, it does not attract FBT. So let's say you've got a loyal couple of team that you want to reward, give them $100 or $200 gift card, fuel card, whatever it is. And if you do that this side of 30 June, and you're not over $300 there in FBT territory, then you can get that as a a tax deduction. Now, I started this by saying only if you're going to do it, because I wouldn't recommend paying $1 to save 37 cents in tax if you weren't going to do it already. So yeah, don't just go and spend money for the sake of saving tax. We've got to do this stuff with intention around it. Another one is prepayments. So this is often pretty good. So we've got to think of the time value of money. And this is actually bringing forward tax deductions from next financial year to this financial year. Now, small businesses in Australia are eligible to get a tax deduction for up to 12 months of prepayments. So often we see where clients have had a big financial year, they're going to have a big forecast tax bill. They'll often make prepayments to things such as rent. If the stationery cupboard needs filling up, and that's going to be inevitable, fill that up pre-30 June. If you've got travel coming up or conferences coming up, why not pay them before 30 June and get the tax deduction before 30 June? If you know you're going to be traveling in September, October, November, December, again, we can claim this for up to 12 months in advance. So look for sort of subscription-based things to prepay. Also, there's a lot of software subscriptions that actually give like considerable discounts for prepaying 12 months in advance as well. You often see like 20% discounts. So have a look in the subscription section of your profit and loss statement for any ideas if you've got a big year and you want to consider this prepayments strategy. Okay. The next one here is cash up your super fund. So again, this is one that needs cash to go into your super fund to get a tax deduction. You will, for every $1 you put into that super fund, you get a tax deduction, but it will be in your super fund, and it depends on your age and all your conditions of release, whether you can pull that out again. But do keep in mind this was one of those ones that require cash to flow that you may not be able to immediately access. So the idea here is, as a tax deduction going into your fund, you'll get a tax deduction at whatever your outside of super tax rate is. Now that could be 39% tax, 47% tax, depending on your situation. Now, when it goes into super, you will pay a 15% contributions tax there if it's a concessional or tax deductible contribution. And what I'll do, I've got a slide a little bit further on in the deck here that talks to the limits because they have changed as well. They've increased, which is nice to see, and I'll touch on that. And then there's also some other rules around bringing forward contributions if you haven't used them over the last 5 years as well. Yeah, I'll talk to that on the super slide in a little bit. But with the cash up your super fund part, the other things to consider is it must be done before 30 June and received by your fund before 30 June. What we recommend is pay it no later than the 20th of June. So again, this is potentially one you want to calendarize in your calendar right now if you've got it open to Outlook or Google Calendar. Is pop a date 20th of June to make sure you pay any super contributions. Now, while we're on the topic of super, I don't have a specific slide for this, but with your super payable for employees, you pay that every quarter. It's due every quarter. Some people might pay it on payday, but let's say for the quarter ended 31 March, which ends in a couple of weeks. That's actually due on the 28th of April, for the super that you pay for your employees. Now, the June quarter super is due on the 28th of July. If you were to pay that super a month earlier, let's say you pay the June quarter right at the end of June, but again, we've got to make sure the money gets to the super funds by 30 June. Then you can actually get that tax deduction in the current financial year. So you may want to add to your calendar appointment on the 20th of June that you want to actually pay your employees super as well to get that tax deduction in the current financial year, because paying it a month early means you get the tax deduction this FY instead of waiting a whole year to get that tax deduction. Okay, hopefully this is all making sense. Alrighty. The next one here is EV and FBT exemption. Not necessarily a fan of EVs, but FBT legislation is a fan of EVs, and there is essentially there's an FBT exemption for buying certain electric vehicles. Now, I say certain, they need to be under the luxury car tax threshold, which I forget the exact number, but it's about 80K or so. So we can't go and get the, I don't know, if BMW make a crazy EV, we can't go and get that one. But I think Tesla Model 3 is included in it, or certain versions of it. And there are quite a few EVs that are eligible for this one. But what it means is that if there is private use of the EV, then we don't have to pay fringe benefits tax on that because of the exemption. Now, we do have sort of models or scenarios of this, depending on the cost of the vehicle and the private use percentage. It can be worth thousands of dollars annually to the client to essentially ignore the private use percentage. Now, this is an attempt by the government of, I guess, pushing the whole EV thingy. What's the word? Pushing us down that route. And that's why this whole thing exists. So again, if it's something that you are keen to do, and I've got clients who, are actually changing their vehicles over to EVs because of this exemption, then do consider that this side of the financial year. Okay, so just keeping half an eye on the chat box. And cool. Alrighty. So we've done a few rapid fire strategies. I want to talk to some changes that take effect this financial year onwards, because at the last federal budget, there were quite a few changes announced, and again, I think without resharing some of them, even us as accountants, but I'm assuming some of our clients potentially still operating on 2 or 3 years ago understanding. So I think it's good just to do a recap on what has changed. The first one, this is actually a great thing. The tax rates have reduced and the tax brackets have expanded, if that makes sense. So from the 2025 financial year, the 19% tax rate is now down to a 16% tax rate. The 32.5-cent tax rate is now down to 30. So they're the two rate drops. And so every taxpayer gets that. It's not necessarily the bracket that you fall into or your income applies to. As an individual, you get the marginal tax rate. So the more that you earn, the higher the percent you get taxed on the dollars as you earn them. So for instance, the first $20,000 or so an adult earns, you get as the tax-free threshold, whether you earn 200 grand or 20K, the first 20 grand is tax-free. So that third dot point there, the 37% tax rate, tax threshold was increased from 120K to 135. So the 37% rate kicks in at 135K now, and the 45% tax rate now kicks in at 190K instead of 180. Now, also keep in mind, these rates here are excluding the Medicare levy, which is 2% on top of these two. So it says 45, but really it's 47% unless you've got a Medicare exemption, and I haven't seen one of those for a while. Okay. So yeah, ballpark, about a 2.5% tax savings for most business owners when we compare it to 2024 FY. So it's actually, if you're earning 100 grand, it is a little bit of a help. Alrighty, depreciation changes. These aren't new. This is just a refresh on what was changed in the federal budget last FY. But yeah, the immediate write-off is $20,000. It was unlimited throughout that COVID period for a certain point. And the way that they write it is because the immediate deduction historically was set at $1,000. They wrote it as a temporary increase to 20K. So it'll be interesting to see what the government does in the budget, which is due at the end of, actually, it's only in a couple of weeks, that we've got our federal budget debrief webinar. Interesting to see what they'll do for next financial year. And if they don't keep it up at the 20K mark and you're looking to purchase equipment, potentially laptops that are a few grand, and you'll be over that $1,000 limit, if that is what it is next year, then you're probably better off doing it this FY versus next. Or even vehicles, like there's not a lot that costs less than 20K unless it's secondhand, but yeah, got to keep that in mind. Okay. Now, I'm not sure how everyone's going to go reading this slide. Yeah, hopefully it's clear enough. But the concessional contributions cap, this is for 2025, increases from 27.5 to 30K per year. So that is the tax deductible contributions limit. Now that includes super contributions on your salary if you're an employee, even of your own business, but it also includes your tax deductible super contributions that you make outside of your salary. Now, just touching on tax deductible super contributions outside of your salary, if you're going to make them this financial year, let's say you put your note in your calendar around that 20th of June mark, you're going to put some money into super, make sure you do your notice of intent to claim a tax deduction, please, because that is a form that is required to be sent to your super fund and received by your super fund to acknowledge that you are going to claim a tax deduction for that contribution. Now, you don't need to do that if it's done through your payroll, all that sort of, SGC or normal employee super. But you do need to do it if it's a tax deductible personal contribution. If you don't do that, the super fund won't record it properly, and then the ATO might disallow your deduction. In fact, they often do just disallow the deduction because your super fund hasn't shown as received that as a tax deductible contribution. So please keep that in mind. Also, if you haven't used all of your concessional contributions, there was a rule that was brought in, I'm pretty sure it was in 2019, that says if you don't use your whole cap, you can roll it forward. Now, there are conditions to that. So if you are going to consider putting in some money from unused super contributions, then make sure you get some advice specific to you around that. There is a superannuation balance limit and potentially some other things that might apply. So yeah, do keep that in mind if you're going to explore catching up on your tax deductible contributions. The next point here is around non-concessional contributions. So this cap has been at 110,000 per year for a while. It's now up to 120K. Now, this isn't a tax deductible contribution. It's an after-tax amount. Now, where we see this in terms of clients, where they might do this is if you've got a fair bit of money outside of super and you want to get it in there, whether you've got an inheritance or you downsized your home and you've got a bit of excess cash, sold a business, sold a large asset, and you've got a fair amount of cash outside of super, you want to get it in there, then your non-concessional contributions caps might be the way to go. And then the other rule down here is that similar to the non-concessional where you can carry forward your unused caps, with non-concessional, there's a rule where you can bring forward future caps for up to you can do 3 at a time. So your current financial year and then the 2 ahead. So you can bring forward your 120K per year now and essentially do 360K per person in the one financial year as a non-tax deductible contribution. Again, yeah, we see this as well when people want to get large amounts of cash into super, or we've even seen people with commercial properties outside of super. They want to get them in there in the super fund where they pay tax at 15% or 0%, and they don't have, the super fund doesn't have the cash, so we use it as a what's called an in specie contribution, so non-cash contribution there. Alrighty, Steve, I have seen your question there. I might do that in the Q&A section. Oh, look at that. That's a nice lead in there. So we are through the meat of the webinar. And we're now in the Q&A section. So we've spoken about, just to sort of recap before we dive into Q&A, we've spoken about what is tax planning, and particularly around the importance of timing being 30 June. And even I've suggested to you a few times to start implementing some of these things a week or a week and a half before that 30 June date, particularly when it's around superannuation, because we've seen a lot of, like, even if the payment bounces back and you have to go again, you want to make sure that you can get that paid and received to the super fund by 30 June. We also want to make sure that you start the process of tax planning months before the end of the financial year, so that you can be calculated, get your cash ready if there's any cash needed, to make that a reality. We've gone through quite a few different strategies, and now we are into the Q&A zone. Alrighty, so feel free to pop your questions in the chat box, and I will go through them in order. All right, Steve has asked, is I'm assuming the depreciation limit 20K per purchase or 20K per year? So it is 20K per asset. So if you want to buy 2 utes that are under 20K plus GST, so this is an ex-GST limit, then yeah, you can buy 2 utes at 19 grand plus GST and claim them both for the business use percent if you're thinking of vehicles. Cool. John, Beck's purchasing a car at the moment under her business. Anything she needs to know other than letting you know when you've purchased it? It's around 24.5K. Cool. So yeah, John, the general guidance we give with car purchases is ideally, if it's going to be majority business use, pop that in the business entity that's got GST registration. That way we can claim the GST on that purchase. And then because it is over 20K, we'll need to revert to the sort of standard small business depreciation rules, which is 15% of the assets cost in the first year, and then 30% of the remaining value of that asset each year after that. Now we also got to apply the business use percent to that one as well. So yeah, that's general guidance. And if it is going to be financed as well, then we just got to make sure. Usually, what we ask there is if clients can send through the loan docs, and then what we can do is and also the car invoice, and then we can pop that in the balance sheet for you and create the loan account so that you can allocate your repayments to that appropriately. Alrighty, Janina, with car purchases, if I'm looking to buy a car, which I'll use for about 75% business and 25 personal, is it recommended to buy it under the business or in personal? So yeah, Janina, I reckon probably the business, not knowing your circumstances in huge detail. But yeah, because you're majority business use, we want to be able to claim the majority of the GST. And when you buy it under your personal name, especially if there's no GST registration there, then we say goodbye to that lovely GST credit on our BAS. So that's probably the best outcome, is buying it in the business name. Now, another tip with vehicles is it's much better to claim car expenses when you've got a logbook. So with the logbook, it's got to be kept for 12 weeks in a row. And if your driving habits don't change materially, you're able to use that logbook percentage for up to 5 financial years. So it's actually pretty handy to get that one. Alrighty. Any other questions when it comes to tax planning? Would you recommend upgrading within a 5-year time? Is this a vehicle? Or this really comes back to, I guess, personal preference. I mean, if you purchase another vehicle, obviously you get the tax deduction for that. But when you sell your old one, you've actually got to make an adjustment. So if you've claimed all the depreciation on that vehicle and you go and sell it for 20K, you've got to essentially pay tax on the business use percent of that 20 grand that you sold it for, and you've got to charge GST to the buyer as well. So yeah, you get it.
Sorry, Ben. I was going to say, yeah, so on Beck's one, it's just like she has her personal vehicle. So we're just getting rid of that one. And then this would be her first one that she's bought in the business. So that one's fairly clean on that one, right? Because it's that
Yes.
one's personal. Whereas mine, it's owned by the company now. So if I was to sell that, that money would have to come back into the company or just go in as a trade-in or whatever off the other vehicle, right?
Yeah, that's right.
Yeah.
But the full value of the vehicle would need to be taken up as an income to the company,
Yeah.
and then again we adjust for the business use percent, and then
Yeah.
you treat the purchase separately from a depreciation perspective, so you can claim the.
Yeah.
Hmm.
Yeah, because I'm just looking at, I suppose from my side, I'm looking at like the current one I've got's coming up to 8 years now. It's, owned in the company and all of that stuff. So it's more of like, you know, anything that we do with it now, it's the cost is going out. So we've already done all the depreciation. It's just it now costs more and more and more if there's any changes. So I'm
Mm.
just sort of like, oh, mine, is it worthwhile that like we're talking, I'm only going to spend like 30, 40 grand. I'm not going to go and buy a bloody Mercedes or anything. Um, yes, I'm just trying to work out if that's a better scenario to just sort of go trade it in. I'll probably get, 13 to 15 for it on a trade in, reduce down the cost to acquire the new car monthly is bugger all. But then I don't have to worry about, the other things.
Yeah. So I guess
Oh, sorry,
if
you go.
Yeah, if yeah, again, when you're looking to sort of upgrade like that, net cost to you per month will definitely increase when you factor in like interest and repayments and bits and pieces like that. So again, it sort of comes back. But sorry, your tax deductions will go up. But if we go back to the thing I said earlier about I wouldn't spend $1 just for the sake of saving tax.
Yeah,
So I'd make the decision more around. Maybe initially from a commercial perspective first. Do you need it? Does the business need to upgrade? And maybe balancing that with a bit of a personal preference too, because sometimes there's a bit of a want behind vehicles. So if you do want to upgrade and you're happy with that extra cost per month to you, then go for it. It's just as long as we're doing it from the best outcome from a tax perspective. So in a GST registered entity and keeping a logbook percent to be able to claim the maximum.
yeah, yeah. Because I'm looking at it from my perspective. For me, it's sort of um, like the cost to acquire, the cost to service, like with the loan or whatever, is pretty much what I would be spending on like maintenance on the existing vehicle, like with any additional things that are happening now because it's just getting that much older.
Yeah.
So like it's pretty much like cost is about the same, but then from a tax perspective, there's obviously that additional depreciation. You're driving around in a brand new car versus a 8-year-old one, blah blah blah, like
Yes.
all of that. I'm not a car guy, so it's like whatever. But yeah, that's what I'm just trying to work out. Is it a better time now versus later scenario?
Mm.
Yeah.
Yep. Yeah. No, that is a good point. Actually, the maintenance.
Solve my world problems, Ben. Yeah.
Yeah. I guess. Yeah. I mean, if it's much of a muchness, but yeah, you get a new set of wheels out of it, then go for it.
Okay.
Yeah.
Perfect. Yeah.
Cool.
Ben said no. No. Appreciate it,
Dear. All good.
man.
All good. Janina has asked, yep. Janina has asked, are you able to explain how fringe benefits tax applies to a company car that's also used for personal? Um, yeah. So Janina, generally, like let's use the example of you having 25% personal use on your vehicle. And assuming let's also assume your company pays about 20 grand in costs to run that vehicle for the financial year. Now you're able to claim 75% of the costs of running that vehicle or 15 grand. Now the other 5K in personal use is what's called a taxable fringe benefit. Now, if that's provided to an employee of the business, like a third party, then we need to do things like lodge fringe benefits tax returns and things like that. Or we can do this thing called an employee contribution, where it's basically, I'm getting a little bit complicated here, but fringe benefits tax, if you're paying that, you're essentially paying 47% tax on the personal use percent for the employee or the benefit that you're providing, the non-business use benefit. And so what we want to do is try to avoid paying a 47% tax rate if we can legally. And there's this thing called an employee contribution where if you're essentially, and how we do this is we essentially invoice the business owner themselves, and they contribute that personal use percent into basically like a loan movement, or literally like a sales invoice that we show it in the P&L to show that we're not actually claiming the personal use percent of the car. Therefore, we don't have to pay fringe benefits tax on that personal use amount. Now, yeah, cool. That's cool to know. Now, a lot of that happens behind the scenes. So if you're a client, we'll often have done those calculations for you and pop that in to avoid you paying 47% tax on the personal amount, and more so that 32.5% or now the 30% tax rate, or the 37%, whatever your marginal tax rate turns out to be. So yeah, I hope that clears that one up. So yeah, when you're paying FBT, and there are instances where clients do that and they're happy, but we often like to manage that with employee contributions. Okay. Had a lot of car questions. All right. Well, if there aren't any more questions, then we might wrap up today's tax planning webinar. I hope that was helpful. And for clients, if you're on the call today, your team at Inspire will be reaching out to start the process with you if they haven't already, the whole tax planning process. So again, keep in mind that we want to be doing that. And I said that there's some tax planning meetings rolling out right now. What you want to be wary of is not doing it so early that things change so much that you need to do it again. So again, we want to make sure that our estimates for your full financial year are as accurate as they can be. And then we want to have that meeting to discuss the tax planning strategies for you. If you aren't working with Inspire, but you want to suss out our tax planning process or what it looks like working with us, then you can book in for a initial chat with one of our accounting team. The QR code is on the screen right now. Otherwise, Tay will be probably posting that link in the chat box. Thanks, Tay. If you do want to have a chat with one of our team to see how we might be able to benefit you. But thanks again, everyone who's joined. Good to see some familiar faces again. And I hope everyone has a fantastic week. Thank you.